Here, this is going to be a video discussing the building blocks of market profile and volume profile. I know originally I said that this is going to be a three-part series, but it's going to end up being a little longer than that because of the amount of information there is to market profile. So this is just going to be the building blocks of market profile and volume profile. Before I get into it though, if you're not following me on Twitter, make sure you're following me over there. I tweet daily plans, order flow clips, and other pretty valuable information. So a link for this will be down below. Also, if you're interested in using an online prop firm, I highly recommend using Apex Trader Funding. You can click the link down below and use my coupon code for 80% off or whatever the best sale is that's going on. I highly recommend using Apex. And finally, if you want to use the same type of DOM that I use, Jigsaw Trading, you can use the link down below as well and use code Yusuf for $30 off. In my opinion, Jigsaw is the best DOM out there. Now that all of that is out of the way, we can go on and get into this. So the building blocks of market profile / volume profile. The way I'm building this is sort of like a base, and then we're slowly adding on and onto it. So now that we understand auction market theory, we can go ahead and jump on into market profile / volume profile. So the first concept that you have to understand is this idea of letters / TPO. So each letter represents a different time frame and price that was visited. The most common time frames that are used are the 30-minute and the 240-minute. The 30-minute is used on the daily, while the 240-minute is used on the weekly. The 30-minute, so for example, A would equal 9:30 to 10, B would equal 10 to 10:30, and etc. So this right here is the market profile collapsed. So you can see how it's overlapping, and when I go ahead and zoom on into it, you can kind of see the letters. This is Sierra, by the way. I think Sierra is the best for charting, so I highly recommend them as well. But yeah, when you zoom in, you can kind of see the letters and stuff like that. And then this is the same exact as this, but instead of us stacking them together, we ended up splitting the profile into their own columns. And I added a screenshot of a candlestick chart. So this right here is the same exact as this, but you can't really tell where the wicks are. I'll explain this in another video of why you'd want to split the market profile up, but it's literally just like taking candlesticks and overlapping them to see where we spent a majority of time in terms of price. So the next concept is known as the range. The range represents the entire day's price from the high of the day to the low of the day. The range tells us whether large time frame participants were present or only small time frame participants. When the range is small and tight, it tells us that the market is in balance and waiting for some kind of news to take it out of balance. So in this example, once again, I marked out the high of the day and the low of the day. So the range for this day was about 90 points, the low being 39.48 and the high being 40.39. Next up is the initial balance. The initial balance is where the first hour of trade is conducted. So for the E-mini S&P 500, that is from 9:30 to 10:30 a.m. Eastern. But for something like crude oil, it would be from 9 a.m. to about 10 a.m. because crude opens up at 9 Eastern. So a break outside of the initial balance implies large time frame participants are present. Traders view the initial balance low as support and the initial balance high as resistance until proven wrong. Once price explores outside of the initial balance, this is known as range extension. A tight initial balance tends to indicate trend days, while a wide initial balance tends to equal balance days where we just rotate. So most charting platforms will, in the settings, they'll allow you to put something to mark out the initial balance. So for my settings, I put this white bar to represent the initial balance, and I just highlighted the level. So in this example, the initial balance was from as high as 40.19 and as low as 39.94. So you can see that we had a very tight, small range. S&P 500 broke out of it, ran into sellers, came back, bounced a little bit off the initial balance low, and then sellers came back and just stuffed it lower. Next up is the open and close. the open and close are very important because they show us where buyers or sellers opened when compared to yesterday. The close represents where buyers/sellers were able to push and close price with the time they had. The opening price allows us to raise questions such as where are we opening in comparison to yesterday. The open and close also demonstrates if we have responsive selling/buying or initiative buying/selling. And there are different types of openings. I'll be discussing this in another video. But once again, for my Sierra settings, I have the opening represented as this red letter A, because once again, A is the first TPO. So this red letter A represents where we opened. And then I have my close as this red arrow to indicate where we closed. The open is pretty important because if we're opening outside of the range, it indicates that we're gapping up, and it implies that buyers or sellers are trying to take us out of balance and trying to explore higher prices. So we kind of have to gauge whether it's being successful or whether it's failing. The value area and the time point of control. So this represents 70% of where most of the time was conducted. Oftentimes you'll hear people refer to this as fair value because this is where a majority, 70% of price was at in terms of time. The POC shows us the price where we spent the most time at. The VAH is the upper part of the distribution. The VAL is the lower part of the distribution. So in this example, / my chart book, I have it set up so that the TPO, the value area is highlighted in this purple. As you can see, so the value area low would be this right here, and then the value area high would be this right over here. And then my time point of control is this orange highlighted area. This is where we spent the most amount of time. Another thing that you might notice is that the volume profile's value area is different. This is why it's kind of important to use volume and time, so market profile and volume profile, because it allows you to see these differences. So the next idea is this idea of single prints. Single prints are represented by a single strand of TPOs that occur in the middle of the TPO structure. It indicates swift buying/selling from buyers/sellers. It shows that there's a lack of time and volume spent there. It indicates that there's no fair value over there, and you'll often hear people say that the single prints need to be filled. It implies that there's improper structure in the market. In this example over here, I pointed to it. So you can see how we have our TPOs over here. They're overlapping, so we spent time at these, we spent multiple periods at these prices, and then eventually we broke out of them after the initial balance closed. We broke out of it, and you can see how it's just a single strand of TPOs. So this is the single prints. Something like this wouldn't be single prints because, as you can see, we have an overlapping of another TPO. This would also be a single print. Buying tails / selling tails, or excess, made up of at least 3 or more TPOs. A buying tail indicates responsive buying and seller's lack of interest. Selling tail indicates responsive selling and buyer's lack of interest. Responsive buying / selling appears at the highs and lows of profiles. The bigger the tail, the more conviction. So if you remember in part 1, I mentioned this idea of responsive buying / responsive selling and initiative selling / initiative buying. So once again, they're found at the bottoms and tops of profiles. So as you can see over here, this is more than 3 TPOs. So this is a selling tail. This is more than 3 TPOs. So this is a buying tail. Poor highs / lows. When we have a lack of excess at the bottom or tops, a poor low / high will be represented by 2 TPOs at the bottom or top. I should say they should be represented by a minimum of 2 TPOs at the bottom or top. A poor low represents sellers who got too short, and a poor high represents buyers who got too long. They are weak sellers / buyers. The thicker it is, the more likely it is to break. Once again, seen like a wick, but the TPO allows us to see the amount of time and volume conducted there. They need to be broken to fix the structure. In this example right over here, you can see how we have a poor high formed we have spent two different TPO periods over here, and you can see how buyers failed to break us out. So what ends up happening usually is they come, they sweep it, and then we can see and pair it with the DOM to see if there's a reoffer after we sweep it, or if they just continue to push this thing higher. So now jumping over to volume profile, there's this concept of low volume nodes. It's important to understand that if a low volume node breaks, it will quickly flush through it. Think of it like a balloon. When it pops, it occurs fast and sudden. Failure to reject/support price of an instrument will lead to a sudden and fast move throughout the low volume node. Important to take notes where they are, know which direction they will lead to, and for us to try to lean on these prices and try to front run them sometimes. In this example over here, I pointed out to the low volume node. As you can see how it's thin volume and not much volume was conducted here. Next up is the high volume node. High volume nodes are seen as thick bars of volumes, and they show areas of interest and acceptance. They tell us that there are people who have been interested. High volume nodes tend to attract price because there's a two-way auction occurring at this price. Both buyers and sellers are deeming price as fair and more active around it. Markets eventually move away from these HVNs, but when we return to them, they tend to act as support and vice versa if the HVN is above. In this example over here, you can see how this is a high volume node because look at the amount of volume conducted here compared to, something like this or like this. So that's it for the market profile/volume profile building blocks. The next part that I'll make is the different types of days. If you haven't already checked out the first part, make sure you do so this can make sense to you. If you have any questions, feel free to DM me on Twitter, and I'd appreciate if you guys could leave a like. I'll see you all later. Take care, everyone.